Meantime, the major averages are rallying for the fourth straight day following the Fed's plans to stick with its forecast of 3 rate cuts by the end of this year. Here with some reaction, Rick Rieder, CIO of Global Fixed Income at BlackRock. Rick, it's good to see you today. Thanks for joining us. So when do you think, when can we expect the Fed to make the first cut?
I mean, I think the market consensus going into the Fed was June. I don't think we learned much different around that. You know, there were a couple of comments yesterday that when the chair talked about we're trying to hit the inflation target, I actually said we're going to hit the inflation target over time. You know, we're still running above trend in inflation. In fact, yesterday I thought it was interesting. The Fed upgraded its growth forecast, upgraded its inflationary forecast, and then still gave the indication we can start middle of the year and quite frankly still get the 3 cuts in. So anyway, I thought that was, I think the market's reaction to it, it was better than could have been the case. And I thought it was I thought the chair did a very good job yesterday thinking through. Listen, we think the data is going to give them a better chance over the next couple of months, and I think but we've got to see it. That is for sure.
You and I were both attending a conference at Emory University this week where you were addressing some of the inflation data points that you're monitoring, and they were as diverse as, and it was a big hit with the business students, as diverse as the prices paid for Taylor Swift tickets to insurance. Can you sort of set the thesis about where we are with goods and services inflation and how the Fed needs to change its monitoring of those?
Yeah, so, I mean, as you think about it, I mean, I've never seen this in my career. I've been doing this a long time. You actually have a dynamic. The dichotomy between goods inflation and services inflation is extraordinary. So, by the way, if you take a look at 3-month, there's a 3-month moving average goods inflation, or 1 year or 6-month moving average, you're actually having deflation or disinflation in goods, where services, the 3-month moving average of core services, is still 6%. Why is this happening? There are parts of the economy I did talk about at the event, what people are paying, not just for Taylor Swift tickets, for F1 events, what they're paying for the Super Bowl, et cetera. But it is a microcosm of the fact that experiences in the world, people are paying. There's a cultural dynamic around paying for experiences and what people are paying for services. And some of that is because the price of goods has come down. You have more disposable income to spend on services. It's a pretty wild dynamic that's at play today. And listen, I think it will continue. There are parts of the Fed's interest rate tool does not affect some of the heavy levels of inflation today. You think about healthcare costs, education costs, insurance. So there's a dynamic, and part of why I think the Fed is right to say the last mile is hard, bringing down service inflation is very hard. But gosh, you look at the more cyclical component, i.e. goods inflation, it's actually negative. So so it's time to start moving that rate down.
Yeah, I went to see Seinfeld 2 weeks ago at the Beacon Theater. There's inflation in those ticket prices, let me tell you. He was funny, though. He made me laugh about how much I paid. Let's talk a little bit about that. I'm curious here. You've made the case in my note that services inflation is the kind of inflation that is the least resistant to the blunt force tool that the Fed has, which is interest rates. Explain why that is, and therefore why it may be a little harder to get down to that 2% target that the Fed has when they're using a tool that may not work as well in that category of inflation as it does with goods.
So it's a long story. I mean, if you go back, and this is why I think the analog of look at what happened when you moved the interest rate in the 80s and 90s. You had a goods-oriented economy. You had an economy that was driven by, you think about energy costs. It was driven by hard assets. Hard assets are financed. Insurance is not financed. Healthcare, most of it is not financed. Education is not financed. So you have a tool that's incredibly imprecise. But what does it impact? And this is why I think the Fed needs to start moving it down. There are some real pernicious effects on parts of the economy. Lower income, you're seeing this play out in terms of credit card charge-offs. Some of the earnings reports you've been chronicling, lower incomes having a harder time. Commercial real estate, local banks are having a hard time. You talk about that a lot on the show. So what's happening is you've got a tool that targets parts of the economy that are interest rate sensitive and doesn't really hit the others, meaning you can get the tool back. I mean, the Fed, you think about if we're running 2.5% inflation, the Fed funds rate is 5 3/8. That's pretty darn restrictive. Even if we get 100 basis points off, it's still restrictive. And so I think that's the right mode. And I think the chair was very, very, very thoughtful about how he addressed that.
Given your worldview here, let's talk about where you think people should put their money. I was very interested that you are talking about private credit, emerging markets, infrastructure, and then, of course, I mean, you're the head of fixed income, so you think high-quality fixed income is a great option.
Listen, I mean, this is a pretty unique point in time. So if you think about, we talk about service level inflation. Why is the Fed keeping the funds rate at 5 3/8? Service level inflation is too high. What it means, though, to buy yield or to get yield, and we launched an ETF called BINC, where we're clipping 6.5, 6.6% yield. How do you do that? When you've got the risk-free rate at such an elevated level, you actually don't have to stretch to take that much risk, and you can get paid 6.5%. Buying things like investment-grade credit, buying things like European investment-grade credit. This is a pretty extraordinary point in time where not only can you buy growth in the equity market, you can build a lot of income in a portfolio. You don't have to take a lot of risk. I would argue today that companies, if you take their credit quality, they should be borrowing 200 basis points lower. The only reason they're not is because the risk-free rate is high, is because service level inflation is high. It's a pretty good environment to book, just get yield into your portfolio. And we're seeing that play out. We're seeing investors go in that direction. I think it's pretty powerful today.